and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis. We deep dive into financials and also tell you the key risks and triggers going forward. Well, let's get straight to our first stock today. My colleague Sonal focuses on a recently listed company and gets us a deep dive on Zaggle Prepaid Ocean Services.
On Inside Out today, we are going to talk about Zaggle Prepaid Ocean Services, which is a recent listing on the bourses, listed at 164 rupees a share, which is equal to the issue price, but since then, it has seen a one-way up move in terms of stock price. Let's talk about the company now. It is a company that offers fintech products and services and has one of the largest number of issued prepaid cards in India, which is in partnership with a number of banking partners. It has three revenue streams as well. The first one is the software fees, the second one is the program fees, and the third one is Propel platform fees. It is sector agnostic, so it basically caters to a number of sectors, be it the banking and finance space, be it technology, healthcare, manufacturing, FMCG, infrastructure, and automobile industries as well. And in terms of the name of companies, a lot of them, be it Tata Steel, Persistent Systems, Inox, there's Wockhardt, PCBL, Hiranandani Group, and Greenply Industries as well. This is just to name a few. In terms of financials, the reported numbers, let's talk about that first. Revenues have grown from 240 crore rupees in FY21 to levels of 553 crore rupees in FY23, and in first half it has come in at 184 crore rupees. Margins, after taking care of the ESOP expenses, they have come in at 16% in FY23. This is after 8.7% in FY21, and now they have come to levels of 8.1% in the first half. Let's now talk about their profits as well. 44 crore rupees in FY21, around that level in FY22 as well, and in FY23 they have come in at around 21 crore rupees. In the first half they are at 17 crore rupees. The company gets maximum of its revenues in the second half of the fiscal year, that's around 60% and 40% in the first half itself. So it's time to understand more about the business, what are the different revenue streams, what are the expenses actually, and what's the future outlook. Let's get going and speak to the management now. Time to understand the business of Zaggle, and we have with us the management of the company, Avinash Godkhindi, who is the MD and CEO. Thank you so much, Avinash, for joining us. And as I was telling you earlier, this is a show where we try to understand the business and take a deep dive as well. So that's exactly the first question. Can you tell us what Zaggle really does? What are the revenue streams of the company, different segments as well?
Sure. Thank you so much for having me on the show and covering Zaggle. Truly appreciate it, Sonal. So we are a SaaS fintech company. We digitize spends. The operating word here is that we digitize spends. So think of any organization, right? They incur so many expenses, and these expenses typically fall in three buckets. There are employees, there are channel partners, and then there are vendors. We work with our corporate customers like Tata Steel, Toshiba, a whole host of these companies, and we help digitize those spends for them. So create a platform, digital platform linked to the mobile app, which is used by the employee or the channel partner, and we are able to give them a 360-degree visibility as to what's being spent, how is it being spent, and this is all linked on one side with the ERP, so that's the system of transactions, system of records, and then you have the system of transactions, which is the card transactions. So we issue a whole host of prepaid cards and corporate credit cards in association with banks. And on our platform, you're able to actually see all the data come from these two platforms, and through pie charts and bar graphs, you're able to understand who's spending, how much is it being spent, why is it being spent the way it is, and also who has approved it.
Oh, okay, interesting. So if we simplify it, say the employee of Tata Steel has a Zaggle card, Great. How does it work for them?
So for the employee, it's very simple, right? He or she is just going to spend the money. It's a Visa or a RuPay card or a MasterCard as well. And they just go and spend it at partner outlets. It could be any outlet, online, offline. And once you make that expense, on the dashboard, automatically the expense reflects. They also can upload the bills. So let's say you've incurred an expense on your personal card, a personal credit card. You could upload a bill on the mobile app. We have a technology called OCR, Optical Character Recognition, which is a AI/ML-driven engine. It reads the bills, and then you click submit, and it goes to your approver. The approver then goes ahead and approves the bill, and then the money is put onto your Zaggle card as a reimbursement. So it could be a reimbursement, or it could be an advance that you have taken, or it could be a part of your salary. The money has come onto the card. So the whole idea is there are different reasons why money would come onto your card. And once you spend it, that data, that intelligence, that insight is married to all the project codes, cost codes, location codes, etc., which are set up in the ERP. And from there, the insights are generated for the corporate SPOC.
Oh, okay. So you have 3 segments of your income stream, right? So can you explain that to us? How are they different? One is subscription model. The other 2 are very different. How does that work for you?
Software income that we generate is our billing to our corporate customers. Customers like Tata Steel, Persistent Systems, Toshiba, Greenply, a whole host of these companies, right? We also levy what we call as our program fees. These are not billed to the user or the corporate, but these are income streams that are generated when you make a transaction. So as a user, when you swipe the card, you generate interchange and other sources of income. And this we bill to our partner banks. Banks like Kotak Mahindra Bank, ICICI, SBI Cards. We work with Yes Bank. We work with IndusInd Bank, a whole host of banks. And these are partners who pay us the program fees. And we also get some commissions from partner merchants. So that's how we monetize.
Okay, so there are different sets of customers that you have, and from all of them, you get a certain set of fees, be it in form of commission or be it form of take rate. So are you seeing, or do you see regular, change, or do you see a revision in those take rates from these different customers that you have? Which is the highest margin segment for you between the 3?
See, we hope that the change in the take rates are always on the upward side, right? And especially on the corporate side. We are always trying to bring more value to our corporate customers, and we hope that because we are bringing in more value to them, they're going to pay us a higher software fee, right? Now that's the theory, and that's the attempt, that you demonstrate that you're bringing in greater value because you're bringing greater compliance, you're reducing leakage, you're reducing fraud. So there are a lot of benefits that we bring to the corporate, apart from saving, number of person hours. So that's the whole idea. But of course, we make a lot of margin in our program fees as well, right? So the whole idea is to we are one of the few profitable SaaS fintech companies which is listed, and profitability has always been one of the key parameters for us. As I always say, hey, look, what's gotten us here is that we've been frugal, nimble, and humble. And while other things change, and they should change, our endeavor would be to try and stay true to this mantra. Okay.
So you said you are one of the few listed companies in this SaaS fintech space who are profitable as well. Just for understanding of our viewers, who are the other peers for you, be it in the unlisted space or the listed space?
See, globally there are a bunch of ones. There are companies like Brex, Ramp, Leo, and some older generation companies like FleetCore, Vex, Expensify.
So no direct peer that you have in the country right now?
See, there are different spaces. Like for employee benefits, there are some other companies that compete with us. In rewards segment, we have some companies that compete with us. On the expense management side, we have companies like SAP Concur, which has been a player that has competed with us. But nobody has a single platform where they're creating
has all the 3 services that you have. Okay, that is interesting. And while we're talking about your business, I would like to see the office as well. I see a lot of interesting things. So let's get going and take a look at all of them and have this conversation there.
Sounds good. Sounds good.
Well, this game can go on, but I have to ask you, what are some of the expenses that you have to incur in the business? Is it something that requires high working capital, long-term debt? How does this work?
So I'll take a pause and answer this seriously because we're talking of expenses, right? So this is a new age business. It's a fintech business, and there's operating leverage. So as we scale, we're seeing efficiencies kick in, margins over time would improve. They've already improved in the last 11-12 years. But the need of a little bit of working capital is there in a B2B business. So ultimately, we are invoicing partner banks, we are invoicing large corporate customers, and they have their own payment cycles, right? So they take a little while to make the payments. But I would say compared to traditional businesses, the need for working capital is very, very low, right? And this is not a business which requires continuous deployment of cash per se, because this is a cash generating business.
Get that point. So if you can give us some numbers when we talk about what your growth prospects or growth focus areas would be, how do you split the margins between the three segments, and what is the outlook, say 2 to 3 years down the line, once the operating leverage that you spoke about kicks in, the ESOP expenses are out of the way?
Right.
What will the margin picture look like? Will it still be high double digits? Because you did see an impact in the first half. It was a decline after growth that you've seen in the last couple of years.
So the decline was primarily because of our ESOP costs. Last year we took about 14.5 crores as our ESOP costs. This year overall we are projecting about 19 crores. We've already accounted for about 13 in the H1, first 2 quarters. And that tapers down. So next couple of years we'll have a little bit in single digits and then it goes away, right? So because in September 22 we gave ESOPs to all our employees who were on our payroll then. And that had an impact. It was an emotional decision. We wanted to, spread wealth. We wanted everybody in the company to make wealth. And that was the thesis there. The margin profile obviously expands. The margins in the software fees is much higher, but obviously making the software fees is a little bit tougher than your transaction income. Because think of it, Sonal, right? When I'm going to a corporate customer, I'm saying, hey, you are already incurring these expenses, and put it onto my payment instrument, and for 100 rupees spend, you continue to incur 100 rupee expense. I'll make out of the interchange and other incomes from my partner bank. That's so simple as a sale. I used to spend 100, I still continue to spend 100 on the Zaggle platform. All I need to pay is the software fee. Where the slight challenge comes is how much can we levy the software fee, right? So let me put it this way, Sonal. This year, our overall growth would be about 40 to 50%, keeping in mind that the money came in only after the first 2 quarters, essentially, right? As we deploy that capital, and we've essentially been largely a bootstrap company for the first 12 years. And now this capital has come in, it's about 450 odd crores, right? 492 crores as primary. So there is a huge amount of expectation that we have that in the coming years we will be able to deploy this capital efficiently and ramp up our margins. I wouldn't want to go into the specifics. I gave you what this year's numbers are looking like, and we are very confident that margins would expand in the coming years. We've also not spoken about what we can do globally. This platform is a platform which lends itself beautifully for global markets, and there the margins are very different, right? Of course, it's not easy to walk into a US market, but it's doable. And that's what we will aim to do in the coming years, to expand globally as well. And that again would help us, expand our margins and our growth. So
when you talk about global plans, do you already have some presence in global markets? If yes, how much is it? And the expansion that you're talking about in global markets, will you look at some acquisition? Is acquisition on cards, maybe in global or in domestic markets as well? We are on the lookout for EBITDA accretive acquisitions, both domestically and globally. Our framework is very simple. What is it that allows us to make 1 + 1 = 11, right? If it's 2, 3, 4, we're not interested. The synergies have to be very, very pronounced, and it has to be something which we all can agree upon, right? That's what we're looking at, and that's something that we are actively exploring. We also see that the global market is a good place to go for acquisitions, because it gives you foothold, it gives you customers, it gives you an understanding of what that market is. Okay, that is interesting. So I think the rest of the conversation we should just sit down over a cup of coffee and complete it. Sounds good, Sonal. So you've spoken about how different segments work, what the growth prospects are, but are there any cross-selling, upselling opportunities available within segments that you operate in? Oh, absolutely, Sonal. If you look at our cross-sell today, it's about 15%. But every company has employees, has vendors, and many of them have channel partners, right? So there's no logical reason why our cross-sell is so low. So one of the things that we are aiming for in the next 3 years is to increase that significantly. And when we have those conversations with our customers, they're more than happy to explore. And we've already started to see some very interesting progress on that front. Okay, so it is a great possibility and opportunity that you always keep an eye out on for. So, it boils down to this. When an investor is looking at your company, when a viewer is trying to understand your business, what are some of the possible risks that you can foresee? Would it be the global expansion that you're talking about? Would it be some impact on spending that we are seeing? Something that you think as a possible risk for the business?
Potential significant regulatory changes, right? Because while we are not directly under the regulation of RBI, as a partner to so many banks, and our significant revenue comes from these banks, any regulation change in RBI does have an indirect impact on us. How do we address that? We basically broad base our revenues. We earn revenues from prepaid cards. We're one of the largest issuers of prepaid cards in the country. We broad base, thank you so much. We issue credit cards, and you try to broad base it from our SaaS fees, right? But eventually, that is an aspect that we have to keep in mind potentially as well in our business. Other than that, I think the space is such, Sonal, every company wants to digitize. Every company wants to make it seamless for their employees to be able to, submit their expenses. And we have tremendous tailwinds both in terms of digitization as well as tailwinds for fintech in terms of UPI, in terms of, GST, DMON, and COVID has helped us a lot. So those tailwinds are really, really something which we believe will continue for a fairly long time.
Do you have a market share figure available? How do you stand versus the market or the other players?
So in the prepaid market, we are one of the largest, if not the largest. And as for the Frost & Sullivan report, when we published it while we were doing the IPO, our share was about 15%. I don't know the exact number. But, if you look at it, the space is fairly fragmented. And we are one of the largest players today in the space.
So last question before we wrap on this discussion and have our cup of coffee. Usually the second half of the business sees higher revenues. For someone who's reading your P&L and trying to understand the business, why is it the second half is better than first half?
So great question, Sonal, and thank you for that. So about 60 to 65% of our revenues always come in H2, and H1 is about 35 to 40%. And the key reason for that, Sonal, is if you look at any of our lines of businesses and revenues, take the employee expense submission. Invariably, employees submit their expenses late, right? Closer to the end of the year, and that's when those claims come in and the business comes through. Similarly, on rewards, a lot of companies tend to reward their channel, partners, etc. in H2. It's either Diwali, it's New Year, or it's just ramping up sales in Q4 because they're falling short of their targets. So given that nature, you'd always see that skew, and we've seen that consistently for the last 11, 12 years.
Okay, all right. So that explains, and we all are guilty of submitting our expenses during the second half, right? Avinash, it has been such a pleasure to speak with you and understand Zaggle's business. Explains a lot. So thank you so much for joining us today.
Thank you so much for this opportunity, Sonal. Truly appreciate it. Thank you.
Okay, with that, we'll wrap on this segment, but with that, it's back to you in the studios.
All right, that was a deep dive into Zaggle Prepaid Ocean Services. But it's time to slip into a short break. We'll be back with another interesting stock. Hariom Pipes is the stock on our Swotlight segment. Don't go anywhere. Welcome back to Inside Out. As promised, let's get straight to our Swotlight segment. Hariom Pipes, that's a manufacturer of structural and multiple industrial pipes and tubes. They have facilities in Telangana, Andhra Pradesh and Tamil Nadu. Now the company has a total manufacturing capacity of around 7 lakh tons. And they are an integrated manufacturing company with strong dealer networks, and they also have diverse product portfolio that consists of mild steel billets and tubes, galvanized pipes, hot rolled, cold rolled and galvanized coils, as well as a scaffolding system business. The capacity addition has been via the organic route and also the Perindurai plant, which was acquired in the past fiscal. They cater to a variety of infrastructural and industrial applications. That's across multiple sectors. Over the past quarter, revenues have moved to around 300 crores. This spike up in terms of the capacity utilization levels, and margins have been holding at around the 12% mark. Volumes have picked up to around 50,000 tons per quarter as they have commissioned a new galvanized pipe plant at Telangana. That's ramping up, and the EBITDA per ton has consistently been holding above that 7,000 rupees per ton. One factor could be operating leverage that is playing out. But the key reasons for a solid EBITDA per ton include value-added steel, that contributes a high proportion of their total sales mix. This as they ramp up the galvanized pipe and coil production at the acquired Perindurai plant in Tamil Nadu. Additionally, part of their raw material, well, that's scrap, so they benefit on the spreads front. The management has also been focusing on keeping a lid on power and fuel costs due to the commissioning of the 2 megawatt power plant, efficient usage of power coming in from IEX, and also installation of a higher efficiency electric melting furnace. Valuations, well, they're supportive at around 15 times EV upon EBITDA. We have annualized the past quarter's EBITDA number, and also we have taken into account debt of around 410 crore rupees. The management, though, is guiding for revenues to spike up to around 2,500 crores as they ramp up capacities which they've added both organically and inorganically. They've also mentioned that they'll not compromise on profitability. Now, if this is the case, then the company is available at around 10 times EV upon EBITDA on FY26 earnings. The management has also stated that the operating cash flows will improve progressively as they're currently maintaining high raw materials as well as finished product inventories due to the commissioning of the new cold rolled mill and galvanized pipe plant. They also say that the operating and free cash flows will turn positive in the next 2 to around 3 quarters. As the market for the products, the product mix and the supply chain, all of them will stabilize. Now, though the stock is near 52-week high, it is yet to see any kind of meaningful contribution or participation coming in from institutions. Now, valuations, that gives some comfort, but it appears institutions would wait for delivery on cash flows and debt reduction, which has been keenly watched. Well, we've run out of time on this edition of Inside Out. It's goodbye from Sonal and myself, but do write to us. Tell us about companies you want us to discuss and you want to hear about. We'll feature some of these on the show. Thanks so much for watching.